All right, today we're diving into what has to be one of the most high stakes business stories out there right now. It's a real life case study about corporate survival, a massive, massive gamble, and at the heart of it all, a single $43 billion question. And it all kicks off with a problem that most companies would absolutely kill to have. So let's just start with this question, one that almost no company in history has ever had to seriously ask itself. What in the world do you do after you've had a $100 billion year? I mean, really, how do you possibly follow that up? In 2022, thanks to its COVID-19 vaccine and treatment, Pfizer hit that absolutely staggering number, $100 billion in revenue. It was historic, a monumental peak. But, the thing about peaks is there's usually only one way to go from there. And this chart, wow, it just lays the challenge bare. From that $100 billion high in 2022, the company's revenue is projected to plummet to around $62.5 billion by 2025. This isn't just a gentle slope we're talking about, it is a sheer drop. This is the crisis. Insiders actually have a name for this whole thing. They call it the COVID cliff. You can think of it as the massive, abrupt financial hangover after the biggest party in corporate history. The insane demand that created that $100 billion year, it's pretty much evaporating. Now, this is where it gets really interesting when you break down the problem. Just look at these numbers. Sales for their COVID treatment, Paxlovid, collapsed by 55%. The vaccine, Comirnaty, fell 19%. And yeah, sure, their core business, all the non-COVID stuff, it grew by a respectable 4%. But that's like trying to fill a canyon with a bucket. It is nowhere near enough to fill that massive hole. Okay, so you're Pfizer. You are staring into this multi-billion-dollar chasm. How do you even begin to survive something like this? Well, their leadership came up with a very decisive two-pronged plan to fight back. But, and this is a huge but, here's the twist that makes this so much more challenging. The strategy can't just solve the COVID cliff. Nope. At the exact same time, Pfizer is facing a second cliff, the patent cliff. See, this is what happens when a drug's patent expires and cheap generics flood the market. For Pfizer, this means another potential $17 billion revenue hole. They're basically fighting a war on two fronts. So CEO Albert Bourla's strategy, when you boil it all down, is actually pretty simple on paper. It comes down to two direct actions. You cut costs and you buy growth. It's a classic corporate playbook, sure, but it's being deployed on an absolutely unbelievable scale. So let's look at the cut part first. It's a massive program they're calling Project Propel, and the target here is just staggering. $7.7 billion in savings by 2027. They're going to get there with things like AI, automation, and yes, downsizing. The goal is simple: get the company's profitability back to where it was before the pandemic chaos. And then we have the second prong, the buy plan. And folks, this is the all-in bet. The goal here is to literally go out and acquire $25 billion in future revenue. The big headline move, of course, is that enormous $43 billion purchase of the cancer drug firm Seagen. And they're already looking for their next target in the booming obesity drug market. And that massive bet, that huge acquisition, it brings us right to the heart of this entire strategic dilemma. It's a high-stakes gamble on the future that really all comes down to a single $43 billion question. $43 billion. I mean, just let that number sink in for a second. That's the price tag for one company, Seagen. It's a move that will define the company for years to come, and it forces us to ask a really critical question. Which, of course, leads you right here. While they're throwing all this cash at buying innovation from the outside, what's happening to the innovation that's supposed to be built on the inside? What about their own R&D? And here is the truly startling contrast. Pfizer's entire internal R&D budget for 2025 is projected to be just $10.5 billion. That's less than a quarter of what they just spent on that one single acquisition. And not only that, the budget is flat to down from previous years. So the strategy is crystal clear. They are prioritizing buying over building. And this is the fundamental choice they've made, right? The buy strategy is fast. It gives Wall Street a clear, simple story to understand, even if it's incredibly expensive. The other path, the build strategy, well, that's slower. It's way riskier. But it's also how you create sustainable long-term value from your own discoveries, like the revolutionary science that led to their COVID vaccine in the first place. So that brings us to the final verdict. We've laid out the problem, the two cliffs they're facing, the strategy, and the huge trade-offs they're making. So now, it's over to you. You get to be the CEO. You decide. The core dilemma is just captured so perfectly in this quote. Was it right to spend $43 billion on an external pipeline instead of using that capital to supercharge its own proven internal R&D engine? So I'll leave you with this final thought. Was this a bold, decisive move to secure the company's future? Or was it a panic buy? Did they just mortgage their long-term future to solve a short-term crisis, all while letting their own powerful engine of innovation start to rust? The final verdict on that is still out.